I've been writing investment memos for over 50 years. In all that time, I've tried to avoid making bold predictions. I've always believed that the future is unknowable, that humility is essential for long-term investment success, and that anyone who claims to know exactly what is coming is either fooling themselves or trying to fool you. This philosophy has served me well. By acknowledging what I don't know, I've avoided the embarrassment of confident predictions that turned out to be wrong. By focusing on process rather than outcomes, I've built an investment approach that works across different environments. By maintaining humility, I've kept my mind open to information that contradicted my existing beliefs. But there are moments when the evidence becomes so overwhelming, when the risks become so apparent, when the gap between price and value becomes so extreme that staying silent feels like a disservice to the investors who trust my judgment. This is one of those moments. I want to be very specific about what I mean by this. I am not saying I know what the market will do next week or next month or even next year. I don't. Nobody does. The short-term movements of markets are essentially random noise driven by sentiment, news flow, and factors that nobody can predict. What I am saying is that certain asset classes have reached price levels that are disconnected from any reasonable assessment of their fundamental value. Prices that can only be justified by assumptions that are almost certainly too optimistic. Prices that leave no margin for error, no room for disappointment, no protection against the normal vicissitudes of economic and business life. I am not going to tell you that a crash is coming in 2026. I don't know that. Nobody knows that. What I am going to tell you is that there are 5 asset classes right now that are so overvalued, so disconnected from fundamental reality, that owning them at current prices is likely to result in significant losses over the next several years. Maybe the reckoning comes in 2026. Maybe it takes longer. But the math doesn't lie. And the math says these assets are priced for perfection in a world that rarely delivers perfection. If you own any of these 5 assets in significant quantities, I urge you to reconsider. Not because I am predicting a crash, but because the risk-reward from current prices is deeply unfavorable. You are not being compensated for the risks you are taking. And in investing, being uncompensated for risk is the cardinal sin. Let me be clear about something before I begin. I am not a perma-bear. I am not someone who always thinks the sky is falling. I've been bullish many times in my career, often when others were fearful. I was buying aggressively in 2009 when people thought the financial system was going to collapse. I was optimistic in 2020 when the pandemic crashed markets and created extraordinary opportunities. But I've also sounded warnings when conditions warranted. In the late 1990s, I wrote memos about the insanity of dot-com valuations. In 2006 and 2007, I warned about the credit bubble and the risks in structured products. In both cases, I was early. The bubbles continued, inflating after my warnings. But eventually, the warnings proved correct. I feel compelled to issue a similar warning now. Not about the entire market, but about specific assets that have reached levels of overvaluation that I find genuinely alarming. These are the assets I would not own at current prices. These are the assets where I see substantial risk of permanent capital loss. These are the assets I believe prudent investors should reduce or eliminate from their portfolios before the inevitable repricing occurs. The first overvalued asset class I am warning about is long-duration growth stocks trading at extreme multiples. I am talking specifically about technology and growth companies trading at price-to-sales ratios above 15 or 20 times, price-to-earnings ratios above 50 or 100 times, or in many cases, companies with no earnings at all trading at valuations that assume decades of perfect execution. Let me explain why these valuations concern me so deeply. The value of any asset is the present value of its future cash flows. That is Finance 101. When you pay 100 times earnings for a company, you are betting that the company will grow those earnings dramatically over many years and that you'll eventually recoup your investment through those future cash flows. But here is the math that most people don't fully appreciate. If a company trades at 100 times earnings and you want to earn a 10% annual return over the next decade, that company's earnings need to grow at roughly 25% annually for 10 straight years. Not grow at all, grow at 25% every single year for a decade. How many companies in history have achieved that? Almost none. The list of companies that have compounded earnings at 25% for a decade is extraordinarily short. And most of the companies currently trading at these valuations aren't dominant industry leaders with proven business models. They're speculative enterprises whose competitive positions are uncertain at best. But the problem goes deeper than just the difficulty of achieving the required growth. The problem is what happens when the growth doesn't materialize. When you buy a stock at 100 times earnings and the company only grows at 15% instead of 25%, what happens? The market reprices the stock to a more reasonable multiple, maybe 30 or 40 times earnings instead of 100. That repricing, combined with the lower than expected growth, can result in losses of 50 to 70%, even though the company is still growing at a rate most businesses would envy. This is the trap of high multiple growth stocks. You can be right about the company being good and still lose enormous amounts of money because you paid too much. The price you pay determines your return. And when you pay extreme prices, your returns are likely to be poor even if the business performs reasonably well. I saw this play out dramatically after the dot-com bubble. Companies like Cisco and Microsoft were genuinely great businesses. They continued growing after the bubble burst. But investors who bought at the peak in 2000 lost money for over a decade because the starting valuations were so extreme. Microsoft didn't exceed its 2000 high until 2016. 16 years of zero returns, despite the company continuing to grow and prosper. That is what happens when you pay too much. Let me give you another example that is more recent. In late 2021, there were hundreds of companies trading at valuations that defied any rational analysis. Companies with no profits, in some cases no revenue, valued at tens of billions of dollars. Companies whose entire investment thesis was essentially that the future would be dramatically different from the present, and this particular company would dominate that future. What happened? Many of these stocks fell 80 or 90% from their highs. Not because the companies failed necessarily. Some of them are still operating, still growing, but because the valuations were so extreme that even decent business performance couldn't justify the prices investors had paid. I remember talking to an investor who had bought a cloud software company at 200 times revenue. I asked him to walk me through the math. What would the company need to achieve to justify that valuation? He couldn't do it. He just kept saying that the company was growing fast and cloud was the future. Growth and a good story aren't worth 200 times revenue. Nothing is worth 200 times revenue. And predictably, that stock fell over 80%. Today, I see dozens of companies trading at valuations that rival or exceed the dot-com peaks. Companies valued at 20 or 30 times revenue with uncertain paths to profitability. Companies trading at valuations that assume they'll become the next Apple or Google, when history shows that most companies don't become the next anything. They just become cautionary tales for the next generation of investors. What particularly concerns me is the concentration of market capitalization in a handful of mega-cap technology stocks. A few companies now represent an enormous percentage of index weights. If these companies merely grow more slowly than expected, if their valuations merely compress to historical averages, the impact on overall market returns could be severe. And investors who think they're diversified because they own an index fund may discover they're actually heavily concentrated in overvalued assets. If you own long-duration growth stocks at extreme multiples, I strongly encourage you to reconsider. The risk-reward is terrible. You might be right about the company being good. You'll probably still lose money from these prices. The second overvalued asset class I am warning about is commercial real estate, particularly office buildings and certain retail properties. This is not a case of modest overvaluation. This is a case of prices that haven't yet adjusted to a fundamental transformation in how we live and work. And when prices finally do adjust, which they must, the losses will be severe. Let me explain what is happening. The pandemic permanently changed how people work before 2020. Office buildings operated on an assumption that employees would commute to a central location 5 days a week. That assumption justified the rents landlords charged and the prices investors paid for office buildings. That assumption is now dead. It is not coming back. Companies have discovered that hybrid work, where employees come to the office 2 or 3 days a week instead of 5, works just fine for many roles. Employees prefer it. Companies can reduce their real estate footprint. The economics favor permanent change. What does this mean for office buildings? It means that the demand for office space is structurally lower than it was before the pandemic, not cyclically lower, where it will bounce back when the economy improves. Structurally lower, meaning the old level of demand will never return. When demand is permanently reduced but supply stays the same, Prices must fall to clear the market. That is basic economics, and we're seeing it play out in real time. Vacancy rates in major office markets are at or near record highs. Rents are declining. Landlords are offering massive concessions to attract tenants. Buildings that were worth hundreds of millions of dollars are selling for fractions of their previous values. But here is the concerning part. Many office buildings haven't been marked down to reflect this new reality. Private real estate funds, which don't trade on public markets, have been slow to write down their values. Banks that hold loans on these properties have been reluctant to recognize losses. There is an enormous amount of denial in the system. This denial cannot last forever. The loans mature. The properties need to be refinanced. And when they do, the actual values will become apparent. I expect we'll see many office buildings worth 40, 50, even 60% less than their stated values. Some will be worth essentially zero, because the cost to maintain and operate them exceeds any rent they can generate. If you own commercial real estate directly, or through non-traded REITs, or through private real estate funds, you need to take a hard look at what you actually have. The values shown on your statements may bear little relationship to what those assets are actually worth in today's market. I've spoken with numerous real estate professionals over the past year, and the disconnect between stated values and actual transaction values is alarming. One fund manager told me that properties in his portfolio are marked at values 30 to 40% above what similar properties have recently traded for. When I asked why they hadn't written down, he said they were waiting for market conditions to improve. But what if conditions don't improve? What if this is the new normal, the debt situation makes everything worse? Many commercial real estate properties were financed with short-term loans that assumed refinancing would always be available at reasonable rates. Those loans are now maturing into a higher rate environment where refinancing is either impossible or requires significant additional equity. Borrowers who can't refinance and can't contribute more equity have only one option: give the property back to the lender. We're already seeing this happen with prominent buildings in major cities. The regional bank exposure to commercial real estate is another source of concern. Many smaller banks loaded up on commercial real estate loans during the low-rate era. As those loans sour, banks will face losses that could threaten their solvency. We've already seen some bank failures related partly to real estate exposure, and I expect more to come. Retail real estate faces similar challenges, though the causes are different. The shift to e-commerce, which was already hurting physical retail, accelerated during the pandemic and shows no signs of reversing. Malls are dying. Strip centers are struggling. Only the highest quality retail locations with essential tenants are maintaining their values. I am not saying all real estate is overvalued. Residential and supply-constrained markets, industrial logistics, serving e-commerce, data centers, supporting cloud computing. These sectors have fundamental tailwinds, but office and lower quality retail are facing structural decline, and prices have not yet adjusted to that reality. The third overvalued asset class I am warning about is high-yield bonds at current spread levels. High-yield bonds, also called junk bonds, are bonds issued by companies with lower credit ratings. These companies have higher risk of default, so they pay higher interest rates to compensate investors for that risk. The key metric for evaluating high-yield bonds is the spread over Treasury yields. This spread represents the extra compensation you receive for taking credit risk. When spreads are wide, you are being well compensated. When spreads are tight, you are not being adequately compensated. Right now, spreads are extremely tight by historical standards. Investors are accepting very little extra compensation for lending to risky companies. This happens during periods of excessive optimism, when investors believe defaults will remain low and reach for any additional yield they can find. The problem is that this optimism is rarely justified. Default rates don't stay low forever. Economic cycles happen. Companies that looked healthy during good times struggle during downturns. And when defaults rise, high-yield bond prices fall sharply. I've seen this cycle play out multiple times in my career in the late 1980s. Tight spreads preceded a wave of defaults in the early 90s. In the mid-2000s, tight spreads preceded the financial crisis. In 2019, tight spreads preceded the pandemic-driven sell-off in 2020. Each time investors told themselves that low spreads were justified, that this time was different, that the economy was strong and defaults would stay low each time, they were wrong. Let me explain the mechanics of why tight spreads are so dangerous. When you buy a high-yield bond, you are essentially making a bet that the company won't default. If the company pays you back as promised, you earn the stated yield. If the company defaults, you lose a significant portion of your principal, typically 50 to 70 cents on the dollar for senior debt, often much more for subordinated debt. At wide spreads, the math works in your favor. Let's say you are earning a spread of 800 basis points over treasuries. That means if defaults are 2 to 3% annually with 50% recovery rates, you are still coming out significantly ahead. The spread more than compensates for expected losses. At tight spreads, the math works against you. If you are earning a spread of 300 basis points and defaults tick up to 4 or 5%, you are losing money. The spread doesn't cover your actual losses. You would have been better off in treasury bonds. This is where we are today. Spreads are so tight that even a modest increase in defaults could result in negative excess returns versus treasuries. You are taking credit risk without being adequately compensated. There is another factor that concerns me. The composition of the high-yield market has changed over time. There are more CCC-rated bonds, the lowest quality tier, than there used to be. The average credit quality has declined. When the cycle turns and defaults rise, the losses could be worse than historical averages suggest. I am not saying high-yield bonds are never attractive. They were extremely attractive in March of 2020 when spreads blew out to over 1,000 basis points. They were attractive in 2009 when spreads exceeded 2,000 basis points. At those wide spread levels, investors were being compensated for risk and then some, but at today's tight spreads, the risk-reward is upside down. You are accepting most of the downside risk of equities for returns only modestly better than investment-grade bonds. That doesn't make sense. If I am going to take equity-like risk, I want equity-like returns. High yield at current spreads doesn't offer that. If you own high-yield bonds or high-yield bond funds, consider reducing exposure and moving to higher-quality alternatives. Treasury securities, investment-grade corporates, even cash. You are not being paid to take credit risk at current levels. The fourth overvalued asset class I am warning about is private equity and venture capital at inflated valuations. This is a more complicated topic because private investments don't have daily price quotes. Their values are determined by periodic appraisals, which creates both opportunity and danger. The opportunity is that patient investors can ignore short-term fluctuations. The danger is that valuations can become disconnected from reality without anyone noticing until it is too late. Over the past decade, enormous amounts of capital have flowed into private equity and venture capital. So much capital that there is arguably more money chasing deals than there are good deals to chase. This flood of capital has driven up prices for private companies, often to levels that exceed what comparable public companies trade for. Think about that for a moment. Private companies are supposed to trade at a discount to public companies because they're less liquid. You can sell a public stock with a click of a button. Selling a private investment can take months or years and often requires accepting a significant discount. That illiquidity should be compensated with lower prices. But in recent years, the opposite has happened. Private companies have often been valued higher than public comparables. Investors accepted this because they believed in the growth stories, because they needed to deploy capital, because everyone else was paying those prices. The reckoning is beginning. As interest rates have risen and the public market bubble in growth stocks has deflated, private valuations are coming under pressure. Many venture capital-backed companies that were valued at billions are now struggling to raise capital at any price. Private equity portfolio companies that were acquired with cheap debt are struggling as refinancing costs soar. The private markets are marked quarterly, not daily, which means the losses are revealed slowly, but they're being revealed down rounds, where companies raise money at lower valuations than previous rounds, are becoming common. Private equity funds are extending hold periods because they can't sell companies at acceptable prices. Distributions to investors have slowed dramatically. Let me share something I've observed about private market valuations that troubles me deeply during the public market bubble of 2020 and 2021. Private valuations ratcheted up dramatically. Companies raised money at ever higher valuations based on comparisons to public market peers that were themselves wildly overvalued. When the public market corrected in 2022, those public comparables fell dramatically. But many private valuations didn't adjust proportionally. Fund managers argued that their companies were different. that they were executing well, that the public market was overreacting. Some of those arguments had merit, but the overall effect was that private valuations became disconnected from public reality. This creates a dangerous situation for investors. The returns you see on your statements may be based on valuations that don't reflect what you could actually realize if you tried to sell. It is paper wealth that may not translate into real wealth. I've also become concerned about the leverage that private equity firms have used. During the low-rate era, private equity firms loaded up portfolio companies with debt to enhance returns. As long as rates stayed low and the companies performed, this worked. But now rates have normalized, and companies that looked healthy at 3% interest rates look stressed at 7% rates. The debt service burden has increased dramatically, leaving less cash flow for equity holders. If you've invested in private equity or venture capital funds, be prepared for disappointment. The stated values in your statements likely overstate what you'll actually receive when these investments are finally liquidated. I expect many investors will ultimately realize returns well below what they were promised, or what current valuations suggest. I am not saying all private investments are bad, some will do well. The best managers with the best deals will generate good returns, but the asset class as a whole is overexposed and overvalued after a decade of excessive capital inflows. The average investor in private equity or venture capital is likely to be disappointed from here. The fifth and final overvalued asset class I am warning about is cryptocurrency and related speculative assets. I've been skeptical of cryptocurrency for years, and nothing I've observed has changed my view. Bitcoin, Ethereum, and the thousands of other crypto tokens have no intrinsic value. They don't generate cash flows, they don't have earnings, they're not backed by anything tangible. Their value depends entirely on future buyers being willing to pay more than current holders paid. That is not investing. That is speculation. And speculation can work for a while, sometimes a long while. But it eventually ends badly for most participants. I've heard all the arguments. Digital gold store of value, hedge against inflation, revolutionary technology. And I acknowledge that some of these arguments have elements of truth. Blockchain technology may indeed have valuable applications. Some people have made fortunes trading crypto, but none of that changes the fundamental problem. When you buy an asset with no cash flows, no earnings, no tangible backing, you are completely dependent on sentiment. When sentiment is positive, prices soar. When sentiment turns negative, prices crash. There is no floor, no fundamental value to provide support. We saw this in 2022 when Bitcoin fell over 70% from its highs. We saw it with countless altcoins that lost 90 or 95% of their value. We've seen it repeatedly throughout crypto's short history. And yet, despite this volatility, despite the frauds and collapses like FTX, despite the clear speculative nature of these assets, many investors continue to hold significant positions. Some have convinced themselves that this time is different, that institutional adoption has changed everything, that Bitcoin is digital gold and will only go up from here. I don't believe it. I think cryptocurrency remains a speculation, not an investment. And speculations eventually mean revert. The people holding when sentiment shifts will experience devastating losses. What particularly concerns me about crypto is the narrative that has developed around it. Proponents have created elaborate justifications for why traditional valuation frameworks don't apply. They've invented new metrics that always seem to show crypto is undervalued. They've created a cult-like community where skeptics are dismissed and true believers are rewarded. I've seen this pattern before with other speculative manias. The more elaborate the justification for abandoning traditional valuation, the more certain I become that traditional valuation will eventually reassert itself. Narratives can sustain prices for a while, but ultimately, assets are worth what they can produce or be exchanged for. Crypto produces nothing, and its exchange value is entirely dependent on continued belief. The institutional adoption argument is also less compelling than it appears. Yes, some institutions have bought crypto, but many of those same institutions bought .com stocks in 1999 and CDOs in 2006. Institutional involvement doesn't validate an investment thesis. It often signals the late stages of a mania when even professional investors succumb to fear of missing out. If you own cryptocurrency, I would encourage you to consider what role it is actually playing in your portfolio. If you view it as entertainment, as gambling money you can afford to lose, that is your choice. But if you are counting on it for your retirement, for your financial security, you are taking risks that I don't think most people fully appreciate. Now let me bring this together and explain what I think prudent investors should do. I am not saying sell everything and go to cash. Markets might continue higher. These overvalued assets might get more overvalued before they correct. Timing is unknowable, and I make no claims about when the repricing will occur. What I am saying is that risk management matters, portfolio construction matters, and holding concentrated positions in overvalued assets is not prudent regardless of what happens in the short term. Here is how I think about it. Every investment involves a trade-off between potential return and potential risk. When assets are fairly valued, you are typically compensated for the risks you take. When assets are overvalued, you are not compensated, or worse, you are exposed to asymmetric downside where you can lose much more than you can gain. The 5 asset classes I've described all fall into that asymmetric downside category right now. Long-duration growth stocks could fall 50% or more if valuations normalize and still not be cheap. Commercial office real estate could fall 40 to 60% as prices adjust to structural decline in demand. High-yield bonds could lose 20 to 30% if spreads widen to historically normal levels. Private equity could disappoint by 30% or more as inflated valuations come back to earth. Cryptocurrency could lose another 70% or more as it has multiple times before. Meanwhile, what is the upside? These assets could continue higher, but the most likely magnitude of gains from current levels is much smaller than the potential magnitude of losses. That is asymmetric downside. That is bad risk-reward. Prudent investors avoid bad risk-reward situations. They seek out asymmetric upside, where potential gains exceed potential losses. They wait for opportunities rather than chasing assets that have already run. So what should you own instead? First, maintain adequate cash reserves. Yes, cash earns modest returns, but cash also provides optionality. When overvalued assets correct, you'll have capital to deploy at better prices. The opportunity cost of holding cash is real, but modest compared to the cost of being fully invested in overvalued assets during a correction second. Focus on high-quality companies trading at reasonable valuations. They exist. Not everything is overvalued. There are profitable businesses with strong balance sheets, durable competitive advantages, and reasonable price-to-earnings multiples. These companies won't make you rich overnight, but they're much less likely to cause permanent capital loss. Third, consider treasury bonds and investment-grade credit. Yes, yields have been volatile. Yes, bonds got crushed in 2022. But at current yield levels, high-quality bonds provide reasonable income with much lower risk than the asset classes I've warned about. Fourth, maintain geographic diversification. The U.S. market, particularly U.S. growth stocks, has outperformed dramatically. But valuations outside the U.S., in Europe, in parts of Asia, in emerging markets, are generally more reasonable. Spreading exposure across regions reduces concentration risk. Fifth, be patient. The best opportunities come after corrections, not before them. If I am right about these asset classes being overvalued, better opportunities will emerge. Having the discipline to wait, to maintain cash, to avoid chasing, will position you to take advantage when prices become more attractive. I want to close with a thought about the nature of investment warnings. Warnings are unpopular. People don't want to hear that assets they own might be overvalued. They don't want to hear that their gains might be temporary. They don't want to hear that caution is warranted when everyone around them is making money. And warnings are often early. The dot-com bubble peaked almost 2 years after I wrote my first warning memos. The credit bubble peaked about 18 months after I started raising concerns. Being early looks exactly like being wrong until the turn happens. So I fully expect that some people will dismiss this warning. They'll say I am too conservative. They'll say I don't understand the new paradigm. They'll say I've been bearish before and the market kept going up. All of that may be true in the short term. These overvalued assets might get more overvalued before they correct. You might make money ignoring my warning for a while longer. But eventually, prices and values converge. They always do. And when they do, the investors who maintain discipline, who avoided the most overvalued assets, who kept powder dry for opportunities, those are the investors who build lasting wealth. I've seen this pattern play out over 50 years. The conservative investors who avoid speculation and focus on value consistently outperform the aggressive investors who chase returns and ignore risk. Not every year, not every cycle, but over full cycles, over decades, over careers. My warning is simple. There are 5 asset classes right now that offer poor risk-reward. long-duration growth stocks at extreme valuations, commercial real estate, particularly office, high-yield bonds at tight spreads, private equity and venture capital at inflated valuations, and cryptocurrency. If you have significant exposure to these assets, I encourage you to reconsider, not because I know exactly what will happen or when, but because the risk-reward from current levels is unfavorable, because protecting capital matters more than maximizing returns, because being patient and disciplined has always been the key to long-term investment success. The reckoning will come. It always does. The only question is whether you'll be prepared when it arrives.